Welcome to The Explainer. Today, we're deconstructing a really fascinating story about a company whose performance and its price seem to be telling two completely different stories.
Okay, let's dive right into this. In its last full year, one company saw its profits jump by nearly 17%. That's the kind of number that just screams healthy, growing business.
And at the very same time, its pipeline of future guaranteed work hit an all-time record of $8.6 billion. They have literally never had more work lined up.
And yet, despite all of this fantastic news, its stock price fell more than 25% from its peak. So what's going on here? Yeah, this disconnect is a real puzzle. And to solve it, we need to understand the company at the very center of it all, Stantec.
So first things first, let's just establish who we're talking about and what they actually do. In simple terms, Stantec is one of the world's biggest and best managed firms that designs the very foundational systems of our society.
Now, what's really interesting here is how their work touches, well, everything. We're talking about the water systems in our cities, the data centers powering AI, our hospitals, bridges, and energy grids, the whole shebang.
So the crucial point is that they operate in sectors that governments are often legally mandated to fund, which brings us to the absolute core of the positive story here.
You see, the source material we're analyzing builds its positive case on three powerful converging elements.
So let's see how this all builds. We're going to look at what they call their fortress backlog, their M&A engine, and their expanding margins. That record $8.6 billion backlog isn't just some big, flashy number. It represents 13 months of guaranteed work that is already signed and sealed.
They also grow by consistently and smartly acquiring specialized firms, like the major US-based firm Page. Then they integrate them really efficiently to expand their reach and their capabilities.
And this chart, this brilliantly illustrates probably the most remarkable part of their recent performance, a dramatic, and I mean dramatic, increase in profitability. They actually hit their 2026 strategic targets a full year ahead of schedule.
So, if the business is so strong, why did the stock fall? Well, that brings us to the single biggest risk that's highlighted in the analysis.
The concern really revolves around a moderation in U.S. organic growth, and that's because of slower government procurement cycles which, you guessed it, spooked the market.
However, the source material argues that while this risk is real, the company has some significant buffers in place, like really strong geographic diversity and, of course, that huge backlog of existing work that isn't even affected.
Okay, let's bring the bull and the bear cases together so we can understand the complete picture that's being presented in this analysis.
So on one side, you have this absolutely exceptional business performance, driven by three really powerful growth pillars. And on the other, you have a specific market concern about a slowdown in one, albeit very large region.
The source's final verdict here is that the U.S. slowdown is a manageable headwind, not some kind of fundamental flaw in the company's strong, defensive business model. So here's the crucial point. That dramatic stock price drop was the market's reaction and, you could argue, maybe an overreaction to this one risk, and that created the whole disconnect we saw right at the start.
And it leaves us with a final, provocative thought. Understanding the difference between a company's underlying health and its short-term market valuation, well, that's often the key to seeing the full picture.